A 513-point drop in the Dow yesterday alone. $4.4 trillion of equity market value wiped out worldwide in 2 weeks. 3 months bills at negative yields and 10 years under 2.5%. The financial market's trying to tell us something about the economy, everybody, but are they right, or is the panic selling unjustified? Let's find out right now with Glenn Hubbard. He was the top economic advisor to President George W. Bush, and now he's dean of the Columbia Business School, which is where we find him this morning. Glenn, good morning to you.
Good morning.
Tell me, are the financial markets right? Are we in a double-dip recession, or are we heading there, in your opinion?
I don't think we're in a double-dip recession, but I think what the financial markets are telling us, and correctly so, is there's a lot of worry out there, a lot of uncertainty that faces business leaders and households. Until we fix that, we're not going to see growth in jobs.
Okay, let's talk about the fix. What is it going to take? How do you restore confidence? How do we prevent what we've seen from eroding confidence further and turning this into effectively a self-fulfilling prophecy where declines in equity markets and strength in bonds leads corporate executives to just tighten their fists and halt all investment in hiring whatsoever?
Well, I think the first step is to stop the policy uncertainty. It's unnerving to have the administration continuing to call for large tax increases at a time when businesses are trying to decide whether to invest, households are trying to decide whether to spend. The second would be to move toward policies that would encourage growth, like tax reform. You know, we could get between 0.5% and 1% of extra growth each year for a decade if we had fundamental tax reform.
Okay, but that's something, Glenn, that surely has to play out over a period of time. An announcement from the White House that no, President Obama doesn't want increased taxes today isn't going to turn the equity markets around, is it?
I think what's going to turn the equity markets around is confidence that government is on top of the fiscal situation. What we just saw in Washington tells us that's not true. And so the question is, when will the president and the Congress produce a long-term fiscal policy path? That's what people are looking for, whether it's voters or investors, and that has to happen in the next year.
Glenn, what role, if any, should the Federal Reserve be playing now? We know that we've seen QE1, we've seen QE2, and we have short-term interest rates effectively at zero. What else could we have, and are any of those ideas good in your opinion?
Well, the Federal Reserve remains very accommodative in terms of monetary policy. There's no inclination really to let its large balance sheet shrink. Personally, I don't think a QE3 would offer much to the economy. There would be a very modest reduction in yields, but still a great deal of risk from that kind of policy. I would advise the Fed not to do it. The Fed has to be vigilant about liquidity and a potential financial crisis, but I think a QE3 would be a big mistake.
Okay, you think it would be a big mistake, but what do you think Ben Bernanke and his fellow policymakers will be inclined to do, irrespective of views like yours?
Well, I think the first thing they'd be inclined to do, I would guess, is hope that the government did something, which is the logical source of action. Good fiscal policy seems unlikely from the administration at this point, but I think that's what the Fed would wish for. Short of that, I think the Fed will be very concerned about aggregate demand and growth in order to promote the job market. I just disagree with the Fed that QE3 will make much of a difference.
Glenn, at what point does the lack of confidence and the degree to which it's exacerbated by these market declines become toxic to the economy?
I think it could become toxic quite soon if not arrested. You know, the problem for business leaders is not that they don't have cash to invest in people or factories. They do. The question is their confidence about the future, and they're looking at things like how will financial regulation evolve over time? How will tax policy evolve over time? What's the long-term fiscal situation? We've got to get some clear answers. Long-term changes can affect the short term. I know that's not how Washington thinks right now, but it's still true.
Glenn, one quick question before we go. Today, there is an all-important report coming from the Labor Department. In fact, it's going to be in about 40 minutes' time. If we see a number like we saw last month, something in the teens in terms of job creation, what will that tell you?
Well, I think it will tell us that the economy is still growing very slowly and is fragile. If you want a lot of job growth, you really need GDP growth growing in excess of 2.5% for a sustained period of time. We're not really seeing that. So I would expect the employment numbers to be relatively weak.
Glenn, thanks for joining us. Glenn Hubbard, he's the
pleasure.
Dean of the Columbia Business School. Nice to see you again. He says that the one thing that will restore confidence to the markets and to the economy is some sense of policy direction from the administration and Congress.